I begin by contemplating the economic forces that shape our daily lives. In this exploration, I will examine three critical economic indicators that provide insight into the functioning of a nation's economy: inflation, gross domestic product, and interest rates. By analyzing these key concepts in clear, precise terms, I aim to offer a comprehensive understanding of topics that influence prices, spending, and overall economic stability. Through this narrative, I intend to illustrate how systematic changes in these areas impact both individual finances and national policies, thereby enabling a better grasp of essential economic dynamics. This discussion remains accessible yet thorough. In this segment, I explore the concept of inflation by relating it to everyday experience. Inflation represents the gradual increase in the general price level of goods and services over time. For example, a product that cost $1 in a previous year might cost $1.10 in the current year, reflecting a 10% rise in price. Such a change, when within reasonable bounds, can indicate a healthy economic environment where consumer demand and production activity are balanced. However, when inflation accelerates beyond moderate levels, it can lead to a rapid loss of purchasing power and uncertainty in planning finances. Moreover, I differentiate inflation from deflation, noting that persistent declines in prices, though seemingly beneficial, may signal economic contraction and reduced incentives for consumption. In discussing these dynamics, I emphasize that understanding inflation is crucial for comprehending broader economic trends, as it influences central bank policies and everyday fiscal decisions. Thus, a clear grasp of inflation not only enables individuals to make informed financial choices, but also assists policymakers in designing strategies that mitigate economic volatility and promote stable growth. This exploration will strengthen our understanding of how inflation impacts both microeconomic behaviors and macroeconomic policies. In this segment, I turn my attention to gross domestic product, abbreviated as GDP, a comprehensive measure of a nation's economic performance. GDP quantifies the total monetary value of all goods and services produced within a country during a specific period, typically 1 year. Conceptually, GDP functions as an economic report card, reflecting the overall health and productivity of the nation. A rising GDP generally signifies expanding economic activities, increased employment opportunities, and improved standards of living. Conversely, a declining GDP may indicate challenges such as diminished production, reduced investments, and potential hardships for businesses and households. Understanding GDP is fundamental for evaluating economic progress and devising policies to foster sustainable growth. By analyzing GDP data over successive periods, economists and policymakers are able to discern patterns of growth or decline, thereby informing decisions related to fiscal policy, investment, and social welfare programs. This quantitative framework offers a lens through which one can assess the impact of external factors such as technological advancements, trade relations, and global economic trends on a nation's prosperity. Overall, GDP serves as a vital indicator that encapsulates the multifaceted nature of economic progress. This detailed insight enables a clearer perspective on a country's economic well-being. In this next section, I examine interest rates as a fundamental economic mechanism that influences both individual borrowing and broader economic conditions. Interest rates represent the cost of borrowing funds, determined by central banking policies and market forces alike. When interest rates increase, borrowing becomes more expensive. This typically results in reduced spending on major purchases, such as homes, automobiles, and business expansions. Conversely, when interest rates are lowered, loans become more affordable, thereby encouraging investments and consumption, which can stimulate economic growth. This precise calibration of rates aims to control inflation while maintaining sufficient economic momentum. In addition, the interplay between interest rates and savings rates is pivotal in shaping long-term financial strategies. Through careful observation of interest rate fluctuations, both policymakers and consumers can better navigate the complexities of economic planning and risk management, ensuring that monetary stability is sustained amid the evolving financial landscape. By appreciating the interconnections between interest rates and overall economic performance, one gains insight into the delicate balance required to manage growth and control inflation. This understanding is essential for making prudent financial decisions, both at the personal and institutional levels. This comprehensive analysis unequivocally reinforces the stability of our robust economic systems. In conclusion, the exploration of inflation, gross domestic product, and interest rates forms an integral component of understanding modern economics. Throughout this discussion, I have methodically examined how price levels, economic output, and the cost of borrowing interrelate to shape both consumer behavior and national policy decisions. This comprehensive analysis offers a structured framework for interpreting economic data and its impact on everyday financial choices. By gaining a clear understanding of these indicators, individuals are equipped to evaluate economic trends with precision and confidence. As you reflect upon these concepts, consider how they influence not only current market conditions, but also long-term fiscal strategies. Embracing this knowledge will support well-informed decisions in both personal finances and broader economic planning. Each metric offers an insight that enhances our analytical skills and empowers us to contribute to future economic policy, thereby encouraging an approach to understanding and engaging with the modern economy.